It looks like we have some folks here. And so, I want to start by saying thank you for the opportunity to talk about something I'm super passionate about. Paul, if you'd like, you can kind of give a little more context about how this whole thing kind of happened.
I wanted to learn about investing. By the way, I want to say thanks to Tequeria for allowing us to do this, but also for being to existing because if you somebody had asked what Slack is, what is Slack, and so Tequeria has a Slack that we what I love about it is you can create different topic channels, and the one channel that I really was happy about was the finance channel because it's something that I'm interested in. We'll get into that a little bit, but when I got into the finance channel, people were out talking about investing because, right now the stock market is, tanking or doing bad, and it's going up and down really right in the last couple of days. I haven't really paid attention to it. So, but they were saying, oh, now's the time to buy this, now's the time to buy that. But I've heard those phrases before, I'm pretty sure if I asked anybody, to, raise their hand if they heard things about stocks or portfolios and things like that, just about everybody would raise their hand, but I've never really had a full understanding of it. And I asked if anybody would be interested in giving it some kind of talk, and Francisco was the first one to reach out, and here we are. I mean, this is how it got started. And the other day, Carlos showed us this screen cap of 256 participants, and that blew me away. But then it also made sense because it showed me that the reality is everybody wants to know about it, but we're not getting that information clarified. And so here we are. Well, hopefully we can help people out here.
Great. Thank you, Paul. And so, we're going to talk about financial wellness. This is essentially maybe a two-part talk. We decided to split it and focus on investing for today because that's what people, seem pretty interested in. But if there's interest, we'd love to talk about, some of the other topics that I usually spend most of my time and my company's time focusing on. So getting into it, there are going to be three things that we're going to talk about. One, I want to introduce myself and Paul, give a little bit of context about our background, our experiences with finance, and share some opinions. Two, we're going to talk about money because I think that's what we're all here for, right? And then three, we want to give an opportunity to allow people to ask questions. I always want to caveat that I'm not a licensed financial advisor with fiduciary responsibility. I'll go more into my background and why my opinions might be relevant, might not be. But I do invite most people that, I think that there are really great financial advisors out there. If you're at the right stage in your life, they actually can be really useful. But that said, sometimes there are just basic principles that you need to follow, right? And so we'll go more into that later. And so, I'm Francisco. I love data. I love math. I love finance, and I love learning. Learning about new tools, new stuff, new computers, and everything in between.
I'm sorry. My name is Paul, and I'm a big gamer, multiplayer gamer, Halo, Apex. Contrary to popular opinion, I do like CSS. I love CSS. I like the design part of web development, and I love Star Trek. I've been watching Star Trek Discovery. Really blown away by it, actually. And then I used to teach physical science. I love physical science, specifically how the universe kind of interacts with each other. And that's just me in a nutshell. So, if you ever want to talk any of those things, hit me up.
And so, I want to start off by going a little bit about my background and to give some context about why some of my opinions might be relevant. So, I graduated high school like some folks do. I did my first, my parents are both from Mexico. My father did a GED. My mom, worked at factories most of her life. Didn't really know much about the education system. Didn't know much about the U.S. credit system. And so, as many of you probably know, the experience is a little bit harder. Right? Like it's challenging navigating those systems and institutions when you don't have that background, right? Or at least it was for me. And so, I kind of stumbled in economics for my first college degree, and then I ended up liking it, and I actually liked the statistics side. So I ended up getting my first master's in economics and statistics. After graduating, I went and worked in the marketing analytics space as a data scientist. I then started working for one of the biggest insurance companies, AIG, working in their data science space for a couple of years. I then had the opportunity to work at Commonwealth Bank of Australia, where I was launching banks in emerging markets like South Africa, Indonesia, China, India, and spent a lot of time in Sydney. Then I had the opportunity to actually get a second master's at Columbia in data science and machine learning. I then, went to work at Goldman Sachs in their consumer bank, where I focused a lot on, the underwriting, analytics, and data science for Marcus, their consumer bank, as I mentioned. Then after a couple of years there, I started my own small fintech called Unidos, where I'm providing financial literacy and tooling for our community. And then that leads me to today.
This is I'm nowhere near the smart guy that Francisco is, but however, I do own a business. I own 132 Design with a couple of other partners. For Latinx's, I'm really proud of that. And we do design and digital strategy. I've always been fascinated with the way money works. Then I've always wanted to learn about investing, but no formal background in it. So I don't know if you're like me, but I've always wanted to know what investing was, but I just, the way that it's structured for the learning environment for finance is very confusing. And I think Francisco will talk about that here in a second. But yeah, that's me. I hate that picture.
I think it's a great picture.
Thanks,
Paul. So I think, I want to start with what have we learned, right? I work in the space for about 8-9 years, and Paul's obviously had some experience. We came to the conclusion that finance is complicated, right? There's a variety of reasons why. We've listed some of them here, right? It's not often taught in school. There's a lot of information, but it's also hard to figure out what's the right information, what's the wrong information. In my experience, there are a lot of generational language and socioeconomic barriers. I grew up in the South Side of Chicago, and a lot of payday loans, right? Not a lot of information about what to use and how to actually have a healthy relationship with your finances, right? And then I don't think that the industry has a very explicit incentive to make things transparent, right? Because banks, well, they're not going to make money from you if you have full transparency into the product, right? Mm-hmm. And so I think that's a core driver of why finance is complicated. Because actually, when you strip down the math and just look at how all these products are similar, they're the same. And it's actually much more intuitive. And so finance doesn't have to be complicated.
Yeah, I was thinking about when you said the payday loans, and when those are quote unquote more accessible to the lower income communities, right? And I always thought that they use jargon and language that you understand. Oh, you need money right now. That's the stuff they tell you. They will gladly tell you that they'll give you money, but then when you talk about the bad side of finance, they'll put that in fine print, and even if you try to read that, it's going to be utterly confusing for most people that don't have a background, in finance.
Yeah, and that's exactly right. Right, it was confusing for me, and I do have a background, so I'm like, I don't know how. I think that there's a disservice to the community, right?
Yeah.
So, money, right? We want to talk about why money is important. And in my experience, with my parents, they always said, money's not everything, and it's not, right? It shouldn't be. There's more to life than money, right? I think we're seeing that right now with the way the world is, right? There, when you lose someone, you realize that that's hard, and no amount of money can stop that. But I do think money controls your life whether or not you want it to, and I think that's like a hard reality to accept, right? But I also think money can protect your loved ones, right? The things that you care the most about. And I talk about that often with my company, right? Because money can be a tool used for protection, right? And then the most important part is that money isn't everything, Yes, it influences your life. It can be a very big pain point, but can also do some good. But again, it's a means to an end.
Yeah, I think one of the more important parts about money is understanding its value. Understanding how those things can affect your life, depending on what you own. And I think when you this one of my second favorite slide, the one where you start talking about the actual investments, that's when I started understanding that money creates value, and that's all around you. I mean, everywhere. I had a quick conversation with my son, and I said, what is something that doesn't hold value? And he thought about it, and I was like, well, my Xbox, I can sell it, but it's not going to be at the original price. And then he said, but the games in it, they're worthless because anybody can get them. And he's like, I can't sell my digital copy. And so we got into that kind of conversation. And that's why I thought that value is super important when it comes to money.
No, great. Thank you.
Mhm.
So I want to talk about fear, right? Because I think, at least for me in my experience, fear of money really, really prevented me from planning. Like I said, came from a working class background. I feel really lucky. I had to work my way through college. I didn't have a lot of money, and I always said oh, I'm approximately correct. It's fine. Things are, and actually, to a degree, I was pretty good with it, but I never actually sat down, put it on paper, and looked at things very, very concretely. Never made a plan about it because I was afraid. I was really afraid of taking control of my finances and looking at them, because in some sense, maybe I had to face the hard reality that I was broke. and that was hard at the time, but after I got older and started looking at things, I was like, actually, I can just plan how to allocate my dollars and actually take control of that. And then I noticed that my fear was being reduced, that anxiety and stress about it was coming down. And so I made this kind of meme-ish chart where simple diagram. Are you afraid of your finances? No. Well, good for you. Awesome. But if you are, well, then make a plan, right? And I think if you make a plan, then the present you are responsible, and you're on top of it, and you're going to crush it. But sometimes, like myself, right, I said, you know what, I'll deal with it in the future, right? And what I really was saying was that future me, that dude's got it all figured out. He's going to just absolutely get my life together, and he knows what he's doing. But future me never came, right? There was this challenge where present me had to deal with it, but future me wasn't there to save me.
Yeah, I mean, there's a tool, and I know we're not going to talk about budgeting today, but there's a tool that I use called YNAB. I have no affiliation with them; they're not sponsoring this by any means, but maybe we'll get one day. I don't know, but YNAB has taught me about knowing where all your dollars are and knowing where they're going. And I thought that, and the way you said it was, the more I knew where my money was, the better I felt about the future, and I could plan for the future better. And that fear started going away. You can take risks, if you know where your money is, and that's kind of a powerful thing. I think that's what we're going to get to in a second. So, but go ahead.
So I'm actually going to skip ahead here, because like I said, we had a section dedicated to, we're two sections actually, dedicated to budgeting and debt, which are two amazing tools. We won't talk about them today, but if you folks do end up really interested and would like to hear more about, those topics, let us know. And then, maybe we can talk to Tequeria about having a second event, because I would rather spend a good amount of time talking about those, because I think they deserve it, right? So let's assume that you got those two tools in place. And so we're going to talk about investing, and I actually kind of frame it as wealth, right? Because I think that's what the goal of investing is, right? Is to have wealth. And so there are going to be a couple, questions that we're going to answer, because I think it's always important to have that goal in mind, not just talk for the sake of talking, but talk to hopefully answer some questions, or questions that I had, right? And so I think the most important question with investing or with building wealth is, how do I get my money to make me money, right? that's the goal of investing, is you put in some money and you get some money out, and hopefully it's a little extra. And I think the core foundational principle is be rational. Don't let anxiety, fear, stress, or emotions control your strategy over it. People in the equities markets will flush cash in and out and will execute losses when they don't have to, if they stick to their convictions and their strategies over the long term, right? When someone tries to short the market or just play on to noise, it can actually be much more consequential to their financial wellness. And so the other kind of core questions that we'll answer is, what is investing? Is investing risky? How much should I be investing? How do I start? And what should I be investing in? Which I think is probably the most important one of all these.
I was thinking about how I came up with this analogy. It's like when you're investing, you're like a reverse bank. You're lending people money to make money with it, but you got to pay me back interest. So I thought that was kind of powerful right there. So
yeah, definitely agree. And that's exactly right. That's the exact way to frame it. And so, to that point, basically investing is taking money that you have, putting it somewhere with the expectation of making some money or generating a profit, right? And so I think I look at this as a cycle, right? In this threefold cycle where you make a plan, right? And we'll go more into that later, but you define some sort of risk appetite, right? Like how comfortable what amount of risk or volatility are you willing to accept during some periods of time? And then, diversify your portfolio. So that way you don't have, as a lot of folks say, all your eggs in one basket, right? And that can look like a bunch of different things, whether it's investing in a fund of funds or a single fund that's diversified itself, or across a bunch of class of assets, right? And we'll go more into that later. And then I think it's important to remember that why do we invest? And obviously the first one is to make money, right? We want our money to work for us, but also it's about preparing for our future, right? I think for most of the folks here, you want to retire with some money. And a safety net, right? So that you don't have to be worried about how you're going to eat in 20 or 45 years, where maybe your skills aren't as valuable as they are now, or maybe they are, but you just want to have a backup plan, right?
Yeah. And go ahead. You're good.
Yeah. So is investing risky? Yes. That's absolutely the point, right? And if it's not risky, then you're probably not going to make that much money from it. And so this is a complicated graph. I'm going to explain it because what I'm trying to highlight here is a concept in portfolio theory. And I think the first thing I want to explain is that I think most folks, like myself, right, think that the more risky an investment is, the higher the reward you should expect, right? But actually, empirically, when you look at the data, that's actually not true. It turns out that up to a certain point, taking on more risk doesn't make you more money, right? In fact, after some certain point, taking on more risk is just like, all right, well, you're just going to lose money here, right? And so I think what I'm showing in this green graph here about the expectation, right, is what someone would call an exponential growth rate. And it corresponds to this axis of 0, 25,000, 50,000, 75,000, 100,000. And so this is kind of a ridiculous graph to say that if you put in, maybe $10 worth of investment, you'd expect to get $25,000 with really high risk. And that's an absurd expectation. But some people believe this. Obviously, this is like an extreme version of that. But I want to highlight that because the reality is actually more interesting, right? Where basically what these little dots here are portfolios, right? You could think of this as like a fund like the S&P 500, and then another index fund, right? And what it says is that if you're a portfolio and you're along this kind of line here, then you're probably performing as best as possible in the market. Because if there was someone else performing better, people would move their dollars into that other portfolio, and then you'd be essentially back on this line, right? And so economists call this the efficiency frontier. It is a principle in modern portfolio theory. I have a link here that highlights a video over it, and it's an important thing to note because for me, it sets the expectation that like, okay, I probably won't beat the market on average, and definitely not for a consistent period of time. Now, some of the points here, like this red point that says suboptimal, what this is saying is that for the same amount of risk, you could actually be getting higher return. So this portfolio, right, is underperforming, right? So as a very concrete example, if you're working with a an investment fund and they say like, oh, you're taking on 10% risk and they're giving you 14% return. But for that 10% risk, there's another fund that could give you like 20% return. Well, you would go to that one, right? You would just move your money. You know that, right? And so that makes sense intuitively. And then this point here basically says, if your portfolio where for a given amount of risk you're overperforming in the market, well, that's not going to be possible. It's impossible because everyone's going to move all their funds there and then essentially wipe out the improvement above the market. And that's kind of like a crude version of it. But
I'm sorry to interrupt.
Of course.
Just because I'm kind of, what I wanted to hear from you, Francisco, was that if we're looking at suboptimal and impossible,
right,
the likelihood of you getting that high return up there on the right side of the green part or the green line, that's like risking your money on something that hasn't proven itself and doesn't have any kind of history.
right?
And you're betting on them, it's like winning the lottery almost. It's highly unlikely to happen, right?
Exactly right.
And then there's no way you can find a sure bet because we all live different lives. I mean, look at the pandemic that just happened. Nobody could have seen that coming. I mean, you've had your warnings and whatnot, but it would have been difficult to predict that unless you do your homework, like some people have been doing. And I think that in the middle, the optimal level, this is understanding that there is risk involved, but that you can mitigate those risks by putting money on sure bets, as sure as they can be, obviously.
Right.
Would you agree with that?
No, I really would. In fact, like the green extremely unlikely side is essentially penny stocks. Just like you said, it's almost like it's like gambling, right? It's like playing the lottery. It's like, hey, maybe you will, but the actual probability weighted expectation, right? Like you're not going to get these kind of dollars. And in fact, what quants at really sophisticated quant funds will do is that they'll look at risk adjusted returns, and they are probability weighting their annualized revenues, right? So more sophisticated shops actually do look at things this way and more intensive. But now let's go to some stuff that's a little bit more concrete, right? So I think a natural question is how much should I be investing? Like, what's the right amount of money? And I think that's a very personal question, right? Because everyone has different lifestyles and it really matters where you live, right? Like if I'm in Montana, I can really have a great lifestyle on a much different amount of money than, living in San Francisco, right? There's going to be different needs. And so I think as a concrete example, I think we start by saying, what if you wanted to save $1 million, right? And why isn't $1 million a nice amount of money? Because if you earned like 5% interest, and that's kind of high, but it's also kind of reasonable. It's not super high risk. Then that year you would earn $50,000 just on having $1 million. So isn't it great to be rich? And I think that what that does is it gives you, it gives you a source of income, right? And then two, it sets you up to have a certain financial lifestyle for retirement. And then it's all about financial freedom, right? And so in this kind of example of saving $1 million, if you aren't rich, right? And you don't have $1 million right now, which is my case. I don't, and how do you get to it, right? So that you can have that level of comfort, so that you can have that stream of income. Well, if you do some pretty straightforward calculations, it turns out if you start at 25 years old, saving $118 a week, by the time you're 70, you'll have $1 million about. And in that time, you'll actually have only saved $276,000. But because of compound interest, assuming a 5% compound interest rate, your money would have accrued to $1 million, which is nuts, right? I mean, that's 4 times the actual amount of money that you're putting in. And that's the power of compound interest. Now, what happens if you start at 30 years old, right? Then it's $156 that you have to put in every week. So now you've had to increase it by a little less than 50%. And now, what if, you're starting later at 35 years old? Well, then it's $209, right? Which is a little less than double what you would have had at 25 years old, right? To save up $1 million. Now, if you saved that same $209 starting again at 25, you'll have saved $1.8 million. Again, nearly doubling the $1 million, which is pretty crazy.
Mm-hmm.
Right. And then that really emphasizes the power of compound interest. So time and discipline are on your side in setting these goals to invest, right? And so the sooner you get started and the more disciplined you are, the better. But choosing a number is, I think, the most important thing. And honestly, you could go with $1 million, you could go with less, you could go with more, right? But I would say, think about it a little bit. Think about what the kind of lifestyle you want to have, and then work towards that. And then we can, and we'll go into different details about how to allocate towards saving to that goal in a little bit.
Also, I think that there's a psychological aspect to it that, and I don't know about you guys, but I came from a place where $1 million didn't seem realistic, and so it makes it difficult to actually envision it. And plus too, I didn't know anything. I knew about investing from sitcoms and whatnot, but I didn't know anything about, compound interest and mutual funds and not taking huge risks and still getting a decent return. And so the psychological part about it is, you can do it, number one, right? And then number two is that it's the long game. I mean, it's for the long game. It's not to make you rich tomorrow. I mean, could it happen? Yeah, it could, but the odds of that happening are slim to none, right? And so that's the way I think that investing should be looked at psychologically, if you ask me. The other thing you kind of made me think about was, when you say how much should I be investing, I think that when you, I bring my son up because we talk every day on these walks that we make. And I told him, I said, well, what would you feel safe investing? I was like, because you know how much money you need to live. So then after you know how much money you need to live with, or how much money you need to live, then the rest of it is really disposable income. How much of that disposable income are you okay with losing? You didn't need it to begin with. I mean, you didn't need it, but that's a way to look at it. I think that's just my opinion though. So what do you think about that, Francisco?
No, I mean, I think that's a very reasonable way to look at it, right? I mean, I think, whatever you have left over after you meet all of your necessities, and then maybe a little buffer for a safety net just in case something, emergency fund, right? I think that's all up to your own choice, right? If you want to spend it all on things, that's okay too, right? You're absolutely entitled. But if you want to put it away for the future and make sure that there's something there for you or for a loved one, then there should be some strategy around it, right? And then it's like, okay, what's the good mathematical strategy to support that? And that doesn't have to be, differential equations. It could just be like, oh, let's just put a little here and there, and then we're set up for success.
Somebody asked a question in the chat. Thank you, Emra de los Santos, for answering it, but I'd like Francisco's opinion. It says, what does this account for inflation? How do you usually factor it in? Now, I imagine that this right here is more like a concrete example. We're just trying to show what could happen.
That's a great question. So this accounts for compound interest, right? The question about inflation, it does matter because it is super important. In fact, there's a lot of economists that debate inflation and the price of goods inflating but not being reflected in CPI. But this does not account for it, right? Inflation adjusted, these things would over time not be as valuable, right? Like, that in 45 years, your money's not going to be like the $1 million won't be as powerful as $1 million today. So that's a great call out. That is true. The reverse problem is really what I would say, that inflation only makes this less valuable, right? So think about how much more it's going to be harmful to just have the cash without putting this away, right?
That's a really good point. If you don't do anything, if you do, yeah.
And that's why you shouldn't hoard too much cash either, right? Because your money is constantly losing its value. That's just the way inflation works, right?
Kind of a mind blown thing here, because I didn't even think about that, but yeah.
Yeah. It's wild. Money just make believe. So how do I start investing, right? This is my opinion, right? Again, I always recommend folks to seek advice of experts, but I would start small, because when you start small, you can get comfortable, and then as you feel more in control, you can do more exotic stuff, right? Like art is an investment, actually. There are people who invest in fine art as a hobby. Not me, but some people do. And so what I'm showing here on the graph is something called liquidity. Liquidity is how quickly you can churn an asset or a financial product into cash. And concretely, what that looks like is, cash is the most liquid asset, because you can just, hand someone $20 and they believe you that that's $20, right? A checking account is a little bit less liquid than cash, right? Because you have to go through a transaction, but that's pretty much completely liquid now. A savings account, legally, you're only supposed to be pulling out from it from, like, I think it's 6 times per month. And then they'll charge you a $10 fee on top of that. And it's meant as a deterrent, because, the government wants you to keep money in your savings account. You don't want to be treating it as a transaction account. It's supposed to be there for you to save. You earn a healthier interest rate from it compared to a checking account. A certificate of deposit, or a CD, is less liquid than that, because usually they're like for 6 months or 12 months or 18 months or 2 years. A money market account is liquid, right? But it's also a little bit less risky. So money market accounts are usually linked to some sort of mutual fund or equities that you can convert into purchasing, like a debit card, like product, right? And then there are bonds. Bonds are also termed, but you can also sell bonds on the markets, right? And so they're still a little bit less liquid. Commodities are essentially like minerals, oil stuff. You can sell that, right? Currencies I didn't put on here, but I could have put on here as well. Stocks and equities, those are pretty liquid. You can sell them throughout the day, actually, right? But there are financial incentives not to. The capital gains tax being the biggest one, where, depending on your tax bracket, there are huge differences in making money from stock versus making money from salary. This is how, many corporations end up making, or many corporate executives end up making so much money, is because they're paid in equity, long-term gains. And then finally, real estate is the most illiquid asset, probably, because it takes a long time to sell a house, right? It's not like you can, take your house and immediately turn it into cash. You have to go and find a real estate agent, get an appraiser, find a buyer, do a bunch of media, find someone to actually say, okay, fine, I'll take it, and then purchase it from you, right? And
I think in real estate, you have to kind of sit on it for quite a while too, before it actually adds, before you see the actual, like, I shouldn't say actual, but like the exponential value, increase.
Yeah, and it can vary, but yeah, that's absolutely right. And so I think, keeping all of those kind of products, that those returns and the liquidity in mind, I think there are kind of 3 ways to start investing. And that's 1, make a plan. And what does that mean, right? Like, 1, I would say set a dollar amount. I'm going to take $500 And maybe I'm going to take $500 once every month, and I'm going to do it for a year before I start to take any money out. And that's the plan, right? At the end of the year, you'll have put away $6,000 in some sort of an investing fund, right? And then choose your risk appetite, right? Like, do you want a low risk products that you want to put your money into? Because then you should expect less return, right? Or do you want medium risk where you'll get more return, but you're not going to take off something wild, right? And then finally, high risk, right? That's like, trading on the VIX, right? Or the volatility market, right? Or trying to like short sell stuff and saying, I'm doing a little bit of speculation, but maybe I'll really get high growth. And that's an absolutely okay strategy. And then finally, select your products, right? Decide how liquid you want your money, right? Because if you're going to be purchasing a house maybe and you want a down payment ready, but you also want to earn a return, that's okay. Then you want to, have like be cash heavy, right? But if you don't need that and you want to put your money in equities, and you want to like leave it there for at least a year, then that's okay too, right? You'll have different preferences, but knowing those preferences is important. And then again, diversify. Maybe you'll take that $6,000 that you have towards the end of the year and allocate it a little percent into real estate, a little percent into CDs, a little percent into single stocks, and yeah.
I like this is why the next slide is my favorite slide. But Juan made a really good point that you can adjust your contributions with inflation to take care of that inflation. I think that's a really good idea. I didn't think about that. And then somebody said, where does IRAs fall in this chart?
That's a great question. Yeah. So 401ks and Roth IRAs, they're a fund, and you can actually allocate your fund however you want, just like this. You can allocate your 401k to be bond heavy, to be high risk, and to be medium. You can even set a target date fund. So you're going to say like, I want to retire in 2040, right? So it's going to choose high risk stuff that's going to start to reduce the risk, so that by the time you're getting closer and closer to 2040, it's going through and it took the right risk during the right time period, and then started to close down the risk once you got closer to the retirement. Which is a great strategy. But I would say that, look at the details of your 401k or your Roth IRA and read kind of the statements, because they offer them about the portfolio that you're allocating to. They'll give at least some light details. Sometimes they'll give a lot of details, and they'll explain some of the way they'll structure the portfolio. Awesome. So what should I be investing in? And this goes into the diversification that I talked about, right? And I think in this example that I created, I wanted to highlight something that, was my experience, right? And this is how I behave, right? Because I think it's important to not just, I'm not selling anybody anything. This is how I do it. I like it. I, invite people to do it however they want. I just think about it this way, where, when I first started working, I didn't have any money. I moved to New York, $400 in my name, my guitar, and I said a lot of prayers. And, so I spent the early part of my 20s just saving cash. So I had like enough savings available just in case anything happened. And, thank God nothing did. I didn't get sick. My family members didn't get sick, but, I wanted to at least have that, even a small safety net. And then as time went on, I started taking some parts of my money and then splitting it up in different ways, right? A little bit into bonds, right? Obviously, I tried to the degree I could, or I comfortably could, put money in my 401k. And, then I started to work into stocks and commodities and mutual funds, and still only small, right? But as I've gotten older and then I've started to build up more cash, I am diversifying more. And what I'm highlighting here is that, you see at 25, you're 100% cash, this green. At 30, you're around like maybe 75%. At 35, well, you're hitting closer to 60. And then once you're at 40, well, now you're like at like 10%, because maybe you put a down payment on a house, so you like spent all your cash that year, and that's okay because you're investing in a real estate, which is the purple, right? Because that's an investment. You can build equity that way. But what I'm starting to say here is that you should be trying to allocate your income towards different portfolios during this middle period. Once you've built up enough cash and you've built up enough of safety net, you can actually start taking on more risk. And then as you start to get older, like I said, you want to start cutting that risk out, because, well, if you're going to retire, you don't want to risk the chance of like having a down year. Like right now, people who have retirement funds set up to make money are like getting crushed, right? Like if you had all your market and all your money in a 401k and you had a high risk fund, we're in a down market. That's not an ideal circumstance. In this sense, you'd be able to mitigate that risk. Yeah.
I wanted to ask you a question too. And this is what I'm going to ask this because this gave me some sort of relief. When you buy into a portfolio or any kind of investment, you're an owner in that, and you're an owner of that asset, correct? And so, go ahead.
Yeah, so in like a mutual fund, you're a shareholder of the mutual fund, right? And they have like, because it gets a little bit more nuanced than that, right? Because the way common stock works, and you can, because you're not buying a single piece of stock, you're buying into a mutual fund, so you're allocated.
I guess so. The point that I was trying to get to was that no matter what, in a down market, it can go back up, and that value that you bought into at that point can be recovered, correct?
Absolutely. Yeah, you don't lose money until you execute a trade. So even if your market valuation cuts in half, well, that doesn't mean anything, right? I mean, the market is saying that it's less valuable right now, but that's not true until you sell.
That's what because when we were having the discussion, when we were rehearsing or going over this, that was the sentence that struck a chord with me, that you said you will not lose value until you sell it outright and you no longer have it.
Right.
And or so I mean, they're no longer in business. Yeah. But I thought but that's kind of a relief though, because you still own it unless they just completely disappear.
Right. And that actually can be a good thing, right? Like, weathering the storm is a very reasonable strategy. And again, that's very calculated, right? Right now, in my opinion, not the opinion of anybody else, is that the markets are still not latching on to the reality of the world today, right? And they're not fully appreciated because it's all short term. They're being reactive. And over short periods of time, the market doesn't always do a good job of reflecting the full economy, but over a long period, the market does tend to reflect the economy. So eventually it will. It's just working itself out.
We have one question. Any chance you can explain the difference between mutual bonds and index funds?
Yes. So mutual funds. So bonds are essentially bonds like they're guarantees by institutions, right? Like, the government bonds that they issue will have a higher interest rate than a certificate of deposit, but they're also for a longer term. And they're essentially a piece of paper, right? And some of them have tax benefits, like municipal bonds in your region are usually tax-free. Not always. So I invite you to look into the details of that. Index funds are different than mutual funds, right? I had to look at the exact detailed definition
I was actually thinking about putting together a Google Doc or of some links that can explain it, because I'm sure Investopedia has some kind of what kind of investments there are. I actually tried to do it before this, but I just couldn't get to it. But I will do it though, because just for my sake. But I'd also like to share it with everybody. So
yeah, of course. And well, so the one thing I'll say about mutual fund is that is chosen by some sort of set of investors, right? So like if you're with like Vanguard, they're choosing the portfolio, and so you're buying into that particular portfolio that they're defining. So that's usually what the difference is. And so actually, before I go here, the reason that I wanted to create this slide and talk about how you're allocating maybe your yearly, or in this case 5-yearly savings, is because that helps set you up for success in a way that looks like this, right? So once you've allocated your monthly savings, in a good year, you can expect that over your life, this is what your portfolio can look like, right? Where you saved somewhere around $300,000 in total amount of money, but because you diversified your portfolio, and this kind of assumes very generous circumstances, you grew your money to nearly $1.4 million, right? And I have an Excel spreadsheet how I calculate it. It's very straightforward, right? I just made some small assumptions, but the point here is that you're taking the right risks at the right time, and you're getting some growth out of it by having a blended portfolio, right? And so one challenge about this is, and this is true of anybody who does investing, right? When times are good, you're going to feel like, man, I wish I would have invested a little more in that one stock, right? That would have been so much better. I would have gotten like double my money. But unfortunately, that's hindsight is 2020, right? And you never have perfect information, and it's more about the process than it is about being right? And in some sense, you should trust that, because that's calculated.
That's why, I'm sorry. That's why I don't like that. Those, how much would you have made if you invested in Netflix, or how much you would have made if you invested in, people are investing in those things all the time.
Yeah.
There's something like that could happen. Why are you not, you could have, yeah, but what about now? Let's worry about now. That's why I think it's so important to start when you can. If you could go back to the last slide for just a second, and I wanted to, what I liked about this slide, this is why it's my favorite, is that let's say you decided to contribute $100, every, week or so, or every month for the rest of your life. This breaks it down on what percentages you want to do it. So if you were to start out at 30 years old, if you were get to 30, by that time you're investing 80% of your cash, of those $100, $80 goes to that. And then the yellow part right there would be like, that percentage would be probably like 10% or something like that, or maybe 15%. And then 5% goes to what that whatnot. Like, that's the plan. Like, that's an actual plan that people can enact. And that's why I like the slide so much. Yeah. And then if you go to the next slide, now you see this, you can look at that 0 point, that 25-year-old you, and say, dang, I invested in Netflix. That's when I invested in Netflix, man. I'm sure glad I did that,
No, exactly. And this is, and one of the things I like about this is, I just chose the numbers, and I chose them based on how I feel about things and how I actually kind of behave, right? But you can just change them. Yeah, I'll put a link here to the spreadsheet, but by all means, change them to reflect whatever preferences and risk tolerance you want, and you can look up what funds earn on an annualized basis, and then make kind of assumptions about it, and then you have a starting point, right? I think it's, you'd be surprised at how much quant funds actually operate much more similar to this, in a much more structured, rigorous way, but not that far off, right? This is kind of the basic disciplines you'll find there. And so the important thing I want to highlight here is these are ideal circumstances, and this is great, right? Like I said, in these circumstances, you're going to say, I wish I would have invested more, but life isn't always like that. Sometimes you have down years, right? Sometimes your house is worth less than what you bought it at, right? So you operate at a loss, and sometimes your stocks go to zero, or, sometimes, you're getting low yield from your cash and checkings, right? But what happens here? Well, what happens here is that you still have all the cash that you originally put on. Even in the worst case scenario, you still have a buffer, right? And that's not nothing, right? It's you're protected in that sense. And that's why I do it, right? Because I know I need that safety net. You know, unfortunately, I don't have super wealthy parents. I love them, you know, but you know, I have to make sure to manage my downside risk. And then in bad times, you'll be happy that you did.
Yeah, this kind of reflects your the the risk versus reward. Like, you know, like, is it risky? Yes, it is risky. But if you plan accordingly and you know when you're going to retire, you should be able to plan, plan those to avoid those downturns. You know,
Yeah.
I think that that's also important to note here in this. I mean, this would be like the opposite of ideal circumstances, right? And
Yeah.
we're hoping that people are prudent and make those plans.
Yeah, absolutely. And so, you know, what should I do next, right? And so that pretty much ends the kind of core parts of what we wanted to talk about, and we're almost out of time for this session. We'll leave time for Q&A. And so I wanted to leave with four major points, right? One, manage your budget. That's the starting point. That is the foundation. Without that, you know, it's hard to be really allocating money diligently. Two, your 401k is really where you want to start. When I first started out, like I said, you know, it was hard for me, and I actually didn't invest in my 401k, even though my company matched it, and that was free money I gave away. And that really sucks, right? Because one, it, you know, them matching it is free money, right? Like, and then two, that's pre-tax money. So basically, if you're earning $50,000 and, you know, you put away $6,000, then, you know, your tax bracket goes to, you know, what is that, 44,000, right? So you're not going to pay tax on it. And, you know, the federal limit is nearly $20,000. So you could actually bump yourself into $30,000 tax bracket, right?
Mm-hmm.
Not that you should, you know, obviously if you can't, and I couldn't at the time handle that, right, with the other burdens you have, then don't. But you should try to utilize a 401k to the degree you can, because it actually is a great tool to reduce your tax bracket and start putting away money, because then you can actually really save up for the long term. Because like I said, this is a game about time. Time is your friend. And then three, you know, start with small calculated risks. I can't emphasize that enough, right? You want to manage your downside. You want to protect yourself, your loved ones, and your assets, right? Because those are a means to an end at protecting them. And don't let the volatility in the markets influence your decision making, right? Be disciplined. If you really think that this is the right strategy to do given the volatility, then that's great. But don't just react to that, right? Really think hard about it. And the last point is hire experts, right? You know, financial advisors can be really great. Accountants are really critical, right? Because many of these investments can have very important tax consequences, and you want to make sure that you speak with them first to make sure you have the full picture of it. Because the last thing you want to do is lose money on an investment and accidentally ruin your taxes in the process. There are strategies actually for how to handle your taxes and your investments, and there's a lot to it. I in no way claim to be an expert. There's a lot of great folks you can talk to. And then, you know, make sure that the financial advisors that you do talk to at some point, have fiduciary duty. That means that they're a registered advisor and that they're regulated by the government. Basically, it makes explicit that they have an agenda only to do what's best for you. This is not true of brokers. Not to say that brokers are bad. That's not true. But just make sure that you check and are aware of their, you know, their incentives, right? And I have a little bit more details on here about some tools that are available and everything else.
There was a episode of Last Week Tonight. I don't know if you watch it, but there was this episode where he talked about where he was doing when they were analyzing their company's 401ks and whatnot, and he did this whole thing on fiduciary responsibility, and it blew me away because I was putting money into a retirement account, And I asked the guy, I said, hey, you guys have that, are you guys fiduciary certified? I didn't know how to call it at the time. And he was like, oh, yeah. And I was like, I didn't like that answer, man. I don't even think you know what that means. So I went and did the research to myself. Luckily they were, but I was like, dude, you don't even know what that means. How can I even trust you with my money, man? Right. But it's because they're I kind of like I think they're like just salesmen really, but anyways.
And that's what I don't necessarily agree that they're sales. Maybe they are, maybe they aren't. There are some good ones, there are some bad ones. That's true of anything, right? But I would say it's just like, it's absolutely okay to pay someone to give you financial advice. I think that's great. I think it's worth it. Do your research. Right? It's the other thing. It's just and scrutinize, right? Because I've met with tons of financial advisors and gotten some opinions, and some of them are really great, right? But some of them I'm like, oh, I don't know if I trust your opinion. And so I think it's important to always just people are honest, people are good, but also make sure that you feel comfortable with what you're signing on to with them, and read the details, right?
Yeah. There was a question here. I think the next one is Q&A, right? Yeah. So
yeah, perfect.
I'll kick it off. I know, right? I'll kick it off with, there is one here. And if anybody else has a question, you can either put it in the chat or just raise your hand, and Francisco can recognize you. Maria asked, for those in their mid-20s, what is something I can do today, this week, to maximize my money other than maximizing my 401k?
Yeah, so I would say that I think ETFs and mutual funds are a great place to start, right? And then, you can pick high risk categories with historical performance. And then the historical performance is a good place to look as a benchmark, right? And usually they'll give you over 20 years, this is how we did. And one thing to look at that and be kind of critical is, well, which 20 years did they pick? Because that matters.
Yes. She she said, other than raising the contributions, I think that's really the best thing you can do in a 401k is to maximize the contribution. And then she went on to ask, is now a good time to raise your contributions? And,
oh, hell yeah. Like, one thing that everybody should know is, buy low, sell high, right? Like that's, nobody ever wants to do it the reverse. So if obviously the market.
Yeah, that's buying low. She asked if that was buying low, if she did it now. Yeah.
And one thing I will say, and it's speculation on my part, I think things are going to be, in the markets, probably getting worse before they get better. Again, just an opinion, everybody is entitled to one legally. So you don't try to time the market too much. I never advise it to. There are ways to there's something called dollar cost averaging, where if you want to invest money in like a mutual fund, because you don't want to necessarily time the market, they can spread your investment, if it's a one-time, over a period of time, so that you're averaging out volatility, basically.
I don't, go ahead.
So like the day-to-day fluctuations won't impact your investment as much, is the point of that.
There was one question I had, and I don't want to take anybody. If anybody has a question, feel free to raise your hand, please.
Well,
go ahead. Go ahead.
Passively managed funds or actively managed funds? I actually don't know. I've never. I know some folks that are quant managed funds, right? Which I guess are in some sense active. And I think the performance, it's a gamble either way, right? In my personal opinion, I'd blend the two, right? I don't know. Maybe go 50-50, see which one performs better, and reallocate it the next year. Sorry if that's not a great answer, but
well, I think, and one question I had was, how do you go about hiring an expert? And honestly, I think that might be even another talk, like things to look for or something like that. But like, how do you know a person? Is there like a Google reviews that we can look at? This guy knows what he's doing, a 5-star review.
Right. There isn't. And that's a really great question, right? In fact, what I would say is, and coming from a data scientist background is really easy. There's this joke I always say, um, in God we trust, all others bring data, right? Make sure that you validate the credentials, right? If this person's going to manage your money, right, and it's going to be looking at your financial information, you should feel really confident in it, right? And if you're going to feel confident, you should feel comfortable paying for it, right? Because if they're doing it for free, then it's like, all right, maybe this isn't perfect. Maybe we get some stuff wrong, right? You generally get what you pay for. Not always, right? There are some really great services for free, but do your research on your financial advisor. Look at it the same way that you think about buying a car, right? Shop around, talk to a couple of different ones. There's no harm in having introductory calls with a bunch of different financial advisors, right? And then see which one you think really serves your needs, and let them give you offerings, right? And depending on which products they're offering you, that can tell you a lot. I've met with brokers where once I read the details of the products they're offering me, I don't trust them anymore. And that's a signal, right? And then they reveal their incentives. They're like, oh, this is the product that they make the biggest premium off of. It's like, okay, well, I get it. They don't have my best success in mind. They just want to make their money, which I don't blame them. But because I know that, I'm going to behave differently. Book recommendations. That's a good question. I heard people really like Black Swan. I don't think that's much of an introduction into investing as it's talking about the markets.
Anything I've learned, I've gotten from Investopedia.
Investopedia is really great. I've read their stuff. I took a money in banking class.
It's not a book though; it's a website. So
yeah, that's true. Well, they give really informative stuff, right? I think, I can get back to folks on that, because what I would like to do is recommend a book that's quantitative-esque, right? It's not super hard and intense in the math, but gives good information. Because I think one of the challenges that I do see is that there are a lot of folks that just offer very generic advice. Sometimes it's a little bit misleading. And I wouldn't want to offer that to you, because I've read a lot of books about like mathematical finance, right? And how people actually do the pricing of these things, how people model some of these things, especially modeling risk. I spent a long time in my career modeling risk. I think that would be much more for helpful for folks. Yes, I love the personal finance subreddit. It's the shit. I absolutely recommend it. Sometimes there's really bad info on there, downvote it. But sometimes there's really great info. And I'm a huge fan of Reddit. The New York City subreddit group is fantastic.
Where can I start to invest? Any places you recommend for a beginner to start?
Yeah, so actually I was going to pull back to here where there's a bunch of online tools, right? And like I said, there was a bunch of products I talked about. Robinhood, like these products all do different things, right? Like I use Fidelity for some of my stuff, for mutual funds and my 401k. Robinhood, you can do E-Trade, you can execute stock trades, right? So some of them are different products for different things. Acorns and Stash are other online or apps that you can use. FinHabits is a Latino one, shout out for that guy. And those are tools that you can use to get started. And, if you want to start with stocks, if you want to start with mutual funds, I think, I imagine some of them offer that. I don't know off the top of my head. I know Fidelity does, and I use Fidelity as well. But it's definitely easy, and it's actually much easier to set these things up. You can actually just directly link it to, and Charles Schwab. I love Charles Schwab. You can directly link it to your account. Pull the money out and put it away. I had, because I worked at different places. I had a bunch of 401ks. And then converting them all and moving them to one, it took me like forever to do it. It wasn't actually until like 2 or 3 months ago that I finally did it. And it only took me an hour to do it, but I put off doing it for like 6 years. because I thought it was going to take forever. And so all these online tools is actually pretty easy. You can actually move it pretty easily. And for a long time, because I was working in the finance space, it was super regulated and a lot of paperwork, so I just didn't bother.
Somebody said, is it too late to, if you've already used your 401k's money twice, is it too late to invest?
No, I mean, well, it depends on what age you are, right? After 70 and a half, I think, is when you're no longer allowed to use a 401k. If you had to withdraw from your 401k for personal reasons, because, times got hard, that's okay. And you can absolutely put more back into it, right? That's what it's there for. So long as you're below the age limit, you absolutely can. I invite you to double check that with the institution that you're setting it up with, but yeah, you should be absolutely able to.
Yeah, I think as you get older, though, the plan would be to be more conservative in your investing, right? So as to not to mitigate the amount of risk.
Yeah, of course.
Cool.
Thank you. No, I appreciate that.
Thanks, Juan. I think that's Juan that was in the finance channel with us too.
Oh, awesome. And so I think there's one last thing I'll say. Enjoy your money. You work super hard for it, but I also think it's worth challenging yourself, because you want to prepare for your future. You want to prepare for your loved ones and take care of the things that matter the most to you. I know I do. That's how I treat finance. I think that's the thing I'm thinking about more, is when I have kids and I want to prepare for their future and my parents.
I saw somewhere that somebody was writing down the things they were going to buy when they got older with their money. Yeah. Maybe that might be something to do, some kind of exercise, like, when I'm 80 years old, I'm going to want that sweet ass, moped that has a radio system in it or something. I don't know,
Yeah.
But just knowing that you can get things when you're older versus seeing, you can use seniors, our seniors today, and see which ones are struggling and which ones are not,
Yeah.
It's just,
And finance is hard. It is really hard, and part of the reason that I like to talk about finance is because I think it can be easier. It can help people a lot. And hopefully all you have enjoyed a little bit of what we're talking about. And so I'm going to stop sharing my screen.
We just have, I think this was a really, really good question, actually. Should you put money into an IRA if your employer doesn't do 401k match, or should you still contribute to your 401k?
You should. You can open up a Roth IRA. And so you can just directly open up your own Roth IRA. You can do it online with Fidelity. That's what I did. It'll have tax implications. You'll have to submit a form, a 1099. It's great. It shouldn't be too hard. And you can do this all online. So you can actually start putting things away. And then if you have an employer, you can have it automated to put stuff in there too. I think that does require a little bit more coordination. Yeah.
Mm-hmm. Hour and 15 minutes, not too bad, man.
Yeah.
Hope people got a lot of valuable information out of this.
Yeah, and then thank everybody for even having the time to listen to us talk. We really appreciate it. I know that people's time is valuable. And I feel really lucky that you all took a little bit out of your day to share it with me and Paul.
They're asking for part 2.
Yeah, well, we can coordinate with Carlos for part 2. Again, it'll be more primarily focused on budgeting and debt. And those things, I think the short version is budgeting we kind of talked to, but debt is a great tool. That can be amazing to help you in great places, whether it's for student loans or for building equity through a mortgage and building your wealth that way. And in fact, for most Americans, they built wealth through a mortgage, and that's a loan, and that's debt. And so I think some folks, especially that follow Dave Ramsey, are so much against debt, and I don't think that's necessarily true. I think actually can be a really powerful tool. Yes, we can absolutely create a Google Doc. I will, create a Google Doc and put stuff in there for sure. And I'll put, like these slides are public, so y'all can see it from there. And I'll add some of the links. Yeah.
Thank you so much, Francisco. I have to head out, but again, like, thank you so much for this. Can we all get a react for Francisco?
Thank you. No, big thanks to Paul for reaching out and even for the opportunity, and thank all of you again.
Man.
Yeah, bye for Chicago. That's what's up.
Cool. All right. Well, we'll plan out the next meeting, and I'll see you guys later.
All right,
good, everybody. Have a good evening and stay safe.
For sure. Bye, guys.